Well, we start with Brian brought in that big red suit. The Santa Claus Rally is a real thing. Since 1950, the Dow and the S&P have averaged about 1.5% over all of that time, and this year did not disappoint. So far, the S&P is up 4.5%, and Danny talked about the naughty and nice list. Lots of that goes into what we're talking about.
Oh, absolutely. And keep in mind, the Santa Claus Rally really begins on Christmas Day. I mean, technically it would have to be the day after because there is no trading that takes place on Christmas Day. But it's really the 12 days of Christmas, where Christmas is the first day, going through Epiphany. So we've seen a little bit of the Santa Claus Rally beginning as far as the anticipation of the gifts that Santa's going to bring. But a lot of times, actually, those gains historically have been during that somewhat quiet period, that week between Christmas and New Year's, and actually technically Epiphany.
And talk about the fact that there is low volume, and when it moves on low volume, that could mean good things in January as that rally continues. And why is this happening really right now? There's really a number of things. Positive economic news certainly is part of that. The slowing down of inflation and a dovish Fed all are lining up for a positive January as well.
It does seem like it. If we look at the inflation data, so on Friday, we got the Fed's preferred measure, the personal consumption expenditure deflator. So that is their official target, 2% over the medium term. And that is actually on a 3-month annualized basis running at close to the Fed's target at about 2%. Now, obviously, this is not mission accomplished for the Fed. It's a question of, do you get there and then do you bounce off of it? But so far, it does look like the momentum is moving in the direction of inflation continuing to move lower, finding maybe a little bit of stability with the housing market now that mortgage rates have come down from above 8% to the high 6%. Still a far cry from where it was just a year ago, but that is some incremental marginal improvement, and maybe that will continue as we go into January.
And one of those factors that we spend a lot of time looking at is the 10-year Treasury peaked at 4.99%. As we talk about it today, 3.85%. That is a substantial move. So right now, the fact is the market thinks that rates are going to come down despite all of the Fed officials trying to walk that back this past week.
Yeah, it was interesting listening to all the Fed officials coming out after Chair Powell's press conference and how they're like, you know what, it's premature to talk about rate cuts at this point, and then they always started talking about rate cuts, about what conditions would be necessary and how, and I think this is really important, that if they do cut, it's not to ease monetary policy. It's really to keep it more stable, because the Fed is beginning to focus more on inflation-adjusted yields. So if you take the nominal yield and subtract off inflation, they want to make sure that that's positive. It's still restrictive, but if inflation keeps moving lower, that real yield moves higher and monetary policy gets more restrictive. So the Fed might try to be a fast follower of inflation lower when it comes to rates. And that, in my opinion, is a very good thing for the outlook. It means that they're not going to be just sort of blissfully ignoring the inflation data, economic weakness. They're going to try to calibrate things to really stick the soft landing.
You know, I always seem to chuckle at sometimes these Fed officials because they're trying to walk it back. But the dot plot, or the dart plot as we like to call it, does suggest that they're going to see 3, and this is 19 Fed governors saying that we expect 3 rate cuts in 2024 and as many as 3 in 2025. So it is a bit incongruent.
It really is. And also, key thing here is that is like the median of all of them. The ones who are likely to vote in 2024, because at the first meeting in January, you get a new roster of people who vote on policy. They might actually have that more bias towards 4, perhaps 5 cuts in 2024.